All right, so transactions with shareholders. So this is where, like with partners, we mentioned that partners could receive distributions. And when they receive distributions, they're not taxable to the partner as long as the partner has basis in the partnership, right? It's like a withdrawal from your bank. It's your money. You're just taking out your money. But once you start taking out more than what's your money, then you've got taxable income at that point. Well, for corporations, these distributions are called dividends, and they are taxable to the recipient. So the shareholder has to pay tax on those dividends. Essentially, it's when the corporation is taking money out of their earnings and profits and giving it to the shareholders. Now, this concept of earnings and profits, it's sort of like retained earnings, but they are calculated according to tax standards, not financial accounting standards. Distributions paid over and above earnings and profits are not taxable. It's like a return of equity. So if I paid $1,000 for stock, and so that's my basis in the stock is $1,000, and the corporation gives me a distribution of $500, but it didn't come from earnings and profits. It came from somewhere else. I don't know. Maybe they borrowed money in order to pay me. I don't pay any tax on that $500 that they send me. It's not a dividend. It is a return of capital. So what that does is it reduces my basis in the stock by that $500. So now that my basis in the stock is 500 instead of 1,000. Okay. If a corporation makes a distribution of property that has a basis less than the fair market value, so in other words, it has appreciated, it's as though the corporation sold the property at fair market value. And so the corporation is actually going to recognize a gain at that point on that property. So here's an example. Sasha received a 500, well, it's not an example of this, but I'm sure there's an example down here. So Sasha received $500 cash. Dividend is fully taxable as long as it did come from the earnings and profits. So it's taxable as a dividend. Next example, Sasha's distribution was in the form of property. Property at a fair market value of $500, basis to Alpha Company of $400. So it's as though they sold it to Sasha. Alpha will record a $100 gain. Sasha is going to report a dividend of $500. Here we've got Quad Company. Earnings and profits of $5,000 makes a $6,000 cash distribution to Quincy. Assuming Quincy has a basis in his stock of at least $1,000, he will report dividend income of $5,000 and a non-taxable distribution of $1,000, but he will reduce the basis of his stock by that $1,000. Now we're going to assume that the basis in his stock is $200. In this case, he would have a dividend of $500, return of capital of $200, and an $800 capital gain that he would have to report. So anything over and above his basis is a capital gain. Let's see. Liquidation. So when the corporation decides to close up shop, essentially they would pay their debts, they would distribute any remaining assets. If the amount that they distribute is less than the shareholder's basis in their stock, then the shareholder would recognize a loss on that. If it's more than what their basis is in the stock, then they would recognize a gain. It's as though the shareholder sold their shares for whatever it was that they received from the company. So example, we've got Tara. Tara got cash of $5,000 and other assets with a fair market value of $7,000. As a result of the complete liquidation, her basis in the stock was $10,000. She is going to report a return of capital of $10,000, which reduces her basis down to zero. The remainder is going to be a capital gain of $2,000. All right. Questions on this? All right.